Today, stick around. We're going to be talking about the three things that we would be doing differently when we got started with the infinite banking concept.
Enjoy the episode.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
All right, guys, welcome back. And I'm excited that you guys are joining us today because Anthony is going to be talking about all of the mistakes that he's made over the years. That's not totally true. We're actually both going to be sharing some of the things that we would do differently as we look back on some of the stuff that maybe we did or didn't do when we first got started implementing the infinite banking concept. So today, we've actually prepared our scenarios independent of each other. So we'll have Anthony start, and then I'll share mine, and we'll kind of go back and forth and give you guys some insight on what we do differently.
You know, this is similar. We did this a prior episode when we said the three worst things to do with infinite banking. And then we actually kind of had a little dispute on who had the most worst things.
I know worse.
We posed that on social media, and they said that I was the worst, or I had the worst things, but not that it's a competition. Okay. It's not.
No.
But this, I think, is a little fun. I like not knowing what you have. And then what I like is I kind of drop my knowledge, and then I later go back and see like your expression on your face, like, oh man,
yeah,
I wish I would have thought of that.
I hope you saw that expression, the big eye roll that I just gave you. But all right, well, let's dive into this. Anthony, how about you kick us off? Let's start us the first thing that came to mind when you looked back and said, hey, this is something that I would do different.
I would have focused less on evaluating and researching the insurance company and put more research on the actual agent.
Okay.
And you know what what infinite banking is unique, right? And we always talk about it's process over product. And you know, I probably put as much research into evaluating the insurance company than I did maybe on all the other places I put my money.
Wow.
But when you say it out loud, it sounds a little odd.
Yeah.
Right. Why am I doing so much research on a company almost 200 years old? I mean, a product that's been around even longer. And I think it's interesting that we've put so much time evaluating the insurance company and whole life in general, when no problem throwing money to Wall Street on mutual funds that own companies we can't even pronounce.
Yeah.
Right. And don't even know what we do. But don't get me wrong. I'm not saying we shouldn't be researching the insurance company. But what I'm saying is we should be doing the same diligent research everywhere we put our money, just not on whole life. And if anything, a whole life is probably the safest place anybody's putting their money. So what I would have done, I would have talked more about the agent. What are you doing with your policies?
Good question.
Right?
Yeah.
How can you help me implement this concept to achieve my goals? So that's one of the things I would do differently. Cam, what's one of yours?
Yeah, when I look back, is I actually first thing that came to mind was more from an advisor role. And the first thing that came to mind is kind of policy design. And we've been doing this for a while. And even in the short span, right, of 12, 13 years, whatever we've been doing it, is we've got some flexibility, and policy design has changed. And one of the things that I used to do often was I would put a big term rider on a policy that allowed us to dump a whole bunch of cash into that PUA rider. And now that I've been in the business for a while, I look at kind of what that does to a policy down the road, and it can cause some pretty serious limitations or issues potentially down the road with some MEC issues. When you get to that year 10, and if you've got a 10-year term rider on that policy, it'll stay on there in year 11, but that price is going to increase dramatically. And so if and when we take it off, that is considered a material change, and you can have some MEC issues. And so right, we've gone through that with some clients. We haven't had any major issues, thank goodness, but it does change the death benefit, and it just does kind of change someone's expectation of kind of where they would be at that 10-year, 15-year mark. So that's the first thing that came to my mind. I'm not a big fan of doing it that way. And at the time, that was kind of the best way that we had to design it. So,
Mm-hmm.
so don't hold it against me is what I'm
I
saying.
will.
Yeah, exactly. Yeah. All right. Awesome. Anthony, what's your number 2? What else would you do differently besides your haircut?
Oh, that's a good one. What I would have done different, I would have gotten convertible term insurance. When I was looking at this, I was so focused on the cash value that I overlooked getting some term insurance. And the reason being, or why I'd want more term insurance, would be twofold. For one, I want to be able to protect my family. And oftentimes we may look at $1 million or $2 million. That sounds awesome, right? But if you're making 200,000 a year and you have $1 million of coverage, all right, so that's 5 years.
Yeah.
You know,
quick.
what's the spouse going to do after that? And it also, I mean, my spouse is good at maybe spending money, but really like investing money is not her forte. So I would have rather have gotten some term insurance to help pay for those expenses if something were to happen to me. But also, I would have gotten it because as we get older, we have a tendency to age.
Wow.
And that sounds like a drop, right?
Yeah. Wow. Just handing out golden
Right.
nuggets.
And
Yeah.
what I mean by that is, I would tell you, when I was in my 30s, never heard of a A1C, right? I might have saw them on the commercials, but I had no idea what they are. I mean, to me, PSA was a public service announcement. And now, not only do I know what it is, let's just say I felt what a PSA is, right?
Lucky guy.
But, and so, I mean, we may have shared on the podcast before, when my first couple of policies, Preferred Plus, you know, and then we got one.
And then it wasn't Preferred Plus.
When you got one on me, the original rating was Table 4. And in essence, I mean, there's a standard and there's levels above standard.
And then there's Table 4.
And then there's below standard, like different levels called tables. So I was a Table 4.
And I couldn't buy enough insurance.
Yeah. And so, but one of the advantages of getting convertible term is you lock in your rating. And, you know, we often talk about how the rating isn't that important, and it really isn't when it comes to cash value, but sometimes you might not be insurable, right? Or believe me, a Table 4 is not going to perform the same as a Preferred Plus. So that's another thing that I would do different. How about you, Cam?
So the second thing, as I'm looking at this option, it's actually pretty similar to my first thing that I would do differently. Again, this is from an advisor's role. Anthony, if you remember, when we first got started, we were instructed on kind of how to build policies for IBC. And there's some things that we don't do now that we did back then. And I still remember, you know, finally kind of taking a look at one of the riders that we used to put on there, and it was a waiver premium rider. The waiver premium rider is kind of like a pared down disability policy. And the reason I say that is because there's usually two elections for your waiver premium rider. There's like the basic waiver premium rider, which if you are diagnosed as disabled, right, you can't do one of 6 daily activities. Then what happens is that the insurance company will actually pay the base premium of your policy.
I do believe it's 2 out of the 6.
2 out of the 6.
Which,
thanks.
you know, I love correcting.
Yeah, thank you. I was just letting you know. I'm glad you're paying attention. The other option is like a total or enhanced waiver premium rider. And if you're diagnosed with not being able to do 2 of the 6 daily activities, then what it'll do is the insurance company will pay the entirety of your base and your PUA. And as great as that sounds, if I am disabled, them paying my premiums is great, but it's not going to solve my issues. My issues is I need monthly stable income moving forward to support myself and my family and potentially my business. And so that's okay. But I'm a much, much bigger fan nowadays of adding kind of a standalone disability policy, which I kind of think of in my mind as like an income replacement. Is, man, God forbid I'm disabled, that disability policy is going to kick in and it's going to be able to support, you know, myself, my family, my business. So that's one of the things I've kind of second guessed over the years is waiver premium riders. I still use it, but just in very limited scenarios now.
You know, I would agree with you on that, except I learned this maybe earlier than you. But and I learned it when I got a policy on my wife.
Mm.
Now she didn't work at the time, so a separate disability policy was not an option. So I'm like, oh, great, we can have this waiver of premium.
Yeah.
But when I looked at it, to me, it's kind of expensive for what you get.
Mhm.
So I didn't put it on hers, and I really have sparingly put it on. But what this also show, I mean, you're right. I think we need to have a better solution or a better product for that problem is a separate disability policy, which is there to replace your income. And to be honest, that's something we haven't given enough attention to.
Yeah.
And we are going to start bringing that to light, because I think a lot of people should have some form of, they need to address that risk. Hopefully they have enough passive income so it doesn't matter. But if it doesn't, then it does matter. So it's something that we do need to address. What I will notice, Cameron, from the two things that you said, don't worry, I'm not going to give you a dig. That kind of showed something that you learned from working with an experienced agent.
Mm.
Right. And so if you got your brother-in-law or your college buddy who just started working in financial services and you want to use them, experience is what really brings us to understand this. Like, we both kind of were taught, we did at the beginning the way we were taught, but then with the experience, we kind of created our own and figured out what was best for our clients. So again, if you're looking for infinite banking, you need to work with somebody who is experienced. And I might just throw in a plug. If you want to talk with us, you can get on a discovery call, 15 to 30 minutes, and we can go over and see if we're a good fit. Link will be in the show notes, but I digress.
Awesome. All right. Third thing, Anthony, what would you do differently besides not wearing that purple shirt today?
Dude, I honestly, I thought this was nice, man. All right. Okay. All right. Or versus a lumberjack.
It's
Like
Christmas.
you're on the
Christmas,
cover
man.
of
It's a Christmas Hallmark movie.
paper towels. Okay. I tell you what I would have done differently. Instead of focus on using my policy for liabilities, I'd focus on buying assets.
That's good. That's
Right.
good. Yeah.
Okay. With a lot of in becoming your own banker, it talks at the beginning about financing cars, right? Or really, and so that's what I was focused on.
Mm-hmm.
And that's what I was looking for. And you're going to see whatever you're going to find what you're looking for, meaning that I was looking for ways to use my policy. So I was looking for liabilities that I could take over, or, well, hey, I go on this vacation and I just run it through a policy, but when I started running the numbers, you're not going to build wealth by using your policy to finance cars or vacations or to finance any sort of liability. In order to do that, you're going to need to use a policy for assets. And I feel that if I would have taken those blinders off and been looking for assets, I think I would have found them. And I feel like I missed out on some great opportunities in real estate.
Mm-hmm.
And to be also, if I had that vision, I probably would have been more open to having larger premiums. So I would have started those policies sooner as opposed to waiting a couple of years. That's my third. What's yours? What's your third one, Cameron? Your third and final one.
My third one, I knew I shouldn't have let you go first. My third one is the same. I literally wrote, I would have started buying assets sooner.
Well,
so
you're a smart man.
To reiterate what you said, right? My experience was I read Nelson's book. I got super excited about the financing piece to it. And I started financing, our backyard or landscaping, then worked up to vacations and then cars. And what I realized when I started financing my vehicles is it became a lot, right? As far as paying the premiums, paying back the loans and everything else. And then I'm the one that's responsible for getting all that money into the policy. And so today, right, to echo what you said just a minute ago, is I'm a much, much bigger fan. And the whole program just works so much more better if you're using the cash value in the policy to acquire cash flowing assets for sure.
Yes, it does work more better, Cameron.
Yeah. And I think honestly, if I look back over from an advisor point of view, I think this is where most people in infinite banking kind of make a mistake and they get into trouble is they'll have 20, 35, $40,000 of cash value in there. And then they go to buy a car and they go buy a $20,000 car, 25, and they have very little cash reserves. And then life happens. I can't tell you the number of times I've seen that. So I'm a much bigger fan, keeping our cash available on hand, accessible for investment opportunities that create cash flow, and then using the bank's money to finance any sort of liabilities. The last thing I was going to share under that was there's two things I looked up. One was the average American has about $58,000 in debt as of right now today. And then last week we were talking to one of our third party kind of LELOC lenders, life equity line of credit lenders, and they were saying that the average policy loan with the big four mutual insurance companies out there is $40,000. If you look at those two numbers, 40 and 60, right? A pretty basic estimate tells us that, man, we need access to like $50,000 like now today, right? And so, man, we've got to have access to 50,000 in our policies immediately, kind of at a bare minimum, in my opinion. Awesome.
Well, I would, anything more to add? Because there was one that I was surprised you didn't say.
I've got one on there. I've got one more point. I mean,
well, I thought the deal was we each come with three.
Well, I know, but I'm an overachiever.
You're trying to overdo.
Yeah,
okay,
so I do have a fourth point. Right. Yeah.
It better be good. Better be good.
This is a good one. The first two were kind of like an advisor role. This one is something that I wish I would have done much sooner. And what I would have done is I would have started buying policies on my parents much sooner than I actually did. My progression was when I came across IBC, I insured myself, I insured my wife, and I insured my kids. And then I looked to the generation above me. And if I had to do it differently, I would have approached putting policies on my parents or my in-laws much, much sooner. The reason for this is 2 of the 4, even several years ago, were uninsurable. So the generation above us, right, our parents, their insurability window closes much, much more quickly. And what I would have done is what you had mentioned before is, man, you got to buy a convertible term policy on my parents and in-laws. And I would have bought that and I would have been converting it systematically over the years. And I feel like I missed out on just a golden opportunity there. So that's one thing that I would have done. I don't know if you remember this, but I presented on this idea at like a think tank a couple years ago about what it would look like if I would have taken, my scenario, I was self-employed, but if somebody, 30, 40 years old would have taken their 401k contributions and applied that to a policy on one of their parents. And I was running that out and running the numbers, and I need to dig that back out. Maybe I will refresh that and then share that in the course, because I think that is a very valid approach and kind of a novel approach to kind of generational planning. Yeah.
Well done.
Well, thanks.
I couldn't add to that one because because
you didn't think of it.
No, because I got a policy on my in-laws. But
so do I. I'm the only one.
I would tell you one thing I was surprised. Well, for now, I was surprised you actually had some good points. But I thought, if you ask people, and we kind of often do ask our clients, and the number one thing they say they would do different is typically they would have got a larger policy from the beginning. And I thought that that's one that you were going to say.
You don't know what I'm going to say.
I know, and I would tell you that the reason why I didn't put it on there, well, for one, I was hoping you would, but for me, I start with a small policy, but that's because I was mentally capable of, and what we tell people is you just got to start this. You're probably listening to this or you've read the book and like, man, this just sounds too good to be true. And that's exactly how I felt. So put my toe in the water and I tried it and it worked just like Nelson said. So that helped me open up my eyes and,
Awesome. Anthony, great points. I'm going to recap kind of what you said. You gave us some really good nuggets today.
You're right.
And just two of them. First one was, you're going to find what you're looking for. That was to quote you earlier. But my favorite one of this was, as we age, we get older.
No, as we get older, we age.
As we get older, we age.
Big difference.
So we're going to leave you guys with those words of wisdom from Anthony Faso. And I hope you guys found some value in the 3 or 4 things that we would have done differently when we first got started with this infinite banking concept. Hope you enjoyed this episode.
Go make it a fantastic day.
Take care.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.